Okay, I think we're good to start. So welcome, thank you for joining our retirement planning webinar this evening. My name is Rita Svensson and I'm the Regional Manager based in Port Macquarie for Australian Catholic Super, and I look after 3 dioceses, so Armidale, Maitland, Newcastle and Lismore. And presenting with me tonight is Paul Sharp, and Paul is one of our financial planners based in Sydney, and he does also look after our clients in the Newcastle region. So welcome, Paul.
Hi, I'm Paul Sharp. As Rita said, one of the planners at Australian Catholic Super. Yes. How are you all doing?
And we also have in the background our moderator, Justin Colley. Justin Colley is also in Sydney and at home, and he is looking after our chat facility. So you will be able to enter any of your questions in that chat facility, and we will address those questions at the end of the webinar. And certainly Justin is very good on the technical side of things. So hopefully we won't have any issues like Paul and I had last time we held our webinar. And Justin was able to help us out. So technology is always good when it works, but if it doesn't, as you know, it's not so great. So fingers crossed this time. So the webinar this evening hopefully will go for about an hour to an hour and a half, and that's just depending on questions. And we look forward to helping you with your retirement plans and also providing you with some superannuation information as well. So before I commence the presentation, I would like to acknowledge the traditional custodians of the land on which I work and live, and recognise their continuing connection to land, water and community. I pay respect to elders past, present and emerging. And also to keep our compliance team on the right side of things. I'm sure you've all seen our disclosure before. If you've attended our seminars and webinars, generally just means that this information that this evening is of a general nature only and does not constitute personal financial advice. You can obtain our product disclosure statement from our website at catholicsuper.com.au and also our financial services guide. So what we will cover today, the topics we will cover include how much do you need for retirement and where will you fund that from? How and why to build your superannuation balance, when you can access your superannuation and how an allocated pension works, Centrelink age pension and benefits, and how Paul and our team of financial planners can guide you and help you reach your retirement goals. I'm sure most of you have heard that Australian Catholic Super are planning to merge with another industry fund, NGS, non-government schools. We are very much aligned. We look after the Catholic sector. We look after the Catholic schools and independent schools. So it's a very exciting opportunity. Currently, both boards are going through a very detailed due diligence process, and that does take a little bit of time. So the merger is planned to proceed sometime next year. So have a look on our website and you can keep up to date with where that's at. Very exciting. So Paul, the $1 million question. Do you need $1 million in super to retire?
Well, I hope not, Rita, because a lot of the people I talk to don't have $1 million. But it is it's a rather personal thing. But views on how much you need do vary. I mean, a lot of people are probably familiar with Scott Pape, the Barefoot Investor. In his book, he says all a couple needs is $250,000 in super to retire, and they can have a comfortable lifestyle. How does he work that out? Well, that couple would be under the assets test for the Centrelink purposes, so they'd have a full Centrelink pension. That's $37,300 odd. He has that couple taking 5% of their $250,000 each year, which, if their fund is making a reasonable return, shouldn't eat into their capital too hard or too quickly. But he also has that couple making use of the work bonus, because you can now work up to earn up to $300 a fortnight without that having that's actual work, without that having any effect on the income test for your super. So that couple gets another 15,600 out of that, and upshot of that is they've got about 65,500 a year to live on. Not bad. That's all we need. Now the only thing is, I think there's a couple of flaws in that. One is it rather depends on you being able to get a full pension, and for a lot of people now, if they were born after 1st of January 1957, that's not going to happen until they're 67. And it does rather rely on you being able to get that $300 a fortnight job and keep doing it, which you may or may not be able to do. But it does illustrate that you could have a reasonable retirement without $1 million each.
Absolutely, Paul. Thank you.
But yeah, if we move on and say, well, okay, what do you need in retirement? It's, as I said before, it's a very personal thing. You know, what's your retirement going to look like? Is it going to be, you know, here we have family time, modest holidays around Australia, time in the garden? Or are we going to be doing international travel, as and when that's available to us again? Are we going on cruises? Are we doing a lot of entertainment and going to the theatre and the restaurants and so on? Particularly the travel, when I talk to clients, makes big differences into what their retirement budget might be.
Absolutely, Paul. I know that it wasn't long ago that during our seminars, I used to tell the audience that if you have a bit of bank of annual leave and long service leave, it's a good idea to actually take a big block of that at the same time and don't go anywhere. But I'm not quite so sure that that's a popular suggestion at the moment.
I think we all know what that's like now.
Yeah, that's right. But I guess it gives you time also to reflect, like you say, on what you really want to do in retirement. And that certainly, as Paul will illustrate, will pave the way financially what you do need in retirement. Yes.
So the previous slide was just some indications. It's very personal, but if you need a guide, if we move on to the next one, the Australian Superannuation Funds Association produces a guide of what they would regard as how much you need for a certain type of lifestyle. So much for a single, so much for a couple. If we look at a couple, they think you can have a comfortable lifestyle on 62,000 a year. So Scott Pape's couple, back as we were looking at, will be comfortable. A modest lifestyle might be 40,000 a year. This is all after tax, but super's mostly tax-free at that point anyway after retirement. Or if you're on the age pension, you're going to have 37,341 a year. So a useful guide to help people think about it. The guides are on the internet, and the descriptions of what that lifestyle might look like are also on the internet. So if we can see it here, your comfortable lifestyle, it's still not as I said, it's still not international travel and an exotic lifestyle. You can have a holiday if you're comfortable. If you're having a comfortable lifestyle according to ASFA, you can have an annual holiday in Australia. You can have some eating out. You can own a decent car, clothes, haircuts, and so on and so forth. So a reasonable lifestyle, but not not exotic. My favorite one here is that if you're comfortable, you can have bottled wine. If you're having a modest lifestyle, you're stuck to cask, and if you're on the age pension, you better start home brewing.
Absolutely. And Paul, I also am aware that you certainly, these figures are based on the fact that you do own your own home as well, aren't they?
Yes, they are. Yes, they are. So a lot of those Centrelink payments. Well, a Centrelink payment would be, they're all assuming you do own your own home and you haven't got a big mortgage to pay off. Yes, that's absolutely right.
That's right. And they are based on actual quarterly surveys of retirees across Australia, the figures. So if you want some more detailed figures, like Paul mentioned, go to the website down there and you can find that even a quarterly breakdown of what your expenditure would be. Sorry, a fortnightly breakdown of what that expenditure would be. So quite a good place to start. So now we also know that it's not just superannuation that's important in all of your retirement nest egg, I guess. I know I was talking to a lady just the other day and she had quite a large share portfolio and she didn't really know what to do with that. And also I meet a lot of members that obviously have investment properties. So Paul, would you like to explain a little bit more about this?
So yes, it's just I think that you've said most of it there, Rita, about people's funding for their retirement won't be just coming out of their super. People do have cash, they have share portfolios, they have property, and also the family house, the home will come into a lot of people's retirement planning at some point. A fair chance, if they're a couple, children have grown up, they may well still be living in the family home. Always a point at which that might just get too big and need to be downsized. We'll talk about it a bit later, but there are some rules now that allow you to put some of that downsizing money into super. I think one of the other things we talk about is just about the shape and the nature of people's assets for retirement funding, because shares a lot of people have, but is that mean your portfolio is not sufficiently diversified? Investment property, as you say, a lot of our members have them, but not always. They're not a liquid asset. And if you're wanting to fund your retirement week by week or fortnight by fortnight income, again, there's discussions we would have with the clients about, the nature of those assets and how liquid and how diversified the portfolio is.
Absolutely, Paul. So Paul has explained the holistic view of that, but superannuation is still the most tax effective way of building that retirement nest egg. Paul, could you explain why that is the case?
Well, if you're in, we've two types of superannuation fund. We'll talk about them throughout this seminar, but we've got what we call a superannuation or an accumulation fund, which is where people build their money, their nest egg for retirement. And we also have what we call a pension fund, which is what people generally take their income from. But both of them are tax effective. The superannuation or income accumulation fund only pays a maximum of 15% tax on its investment earnings. Now that's probably quite a bit less than if you're on, a lot of people we talk to, probably on a salary of 80 to 100,000. Means they're paying 35% odd tax on everything they earn above 45. So if they invest outside super, they'll be paying that 35% tax. If they invest inside super, the most they'll pay is 15% tax. And that's part of the news. The other good news is that once that money moves to an account-based pension for retiree, the fund doesn't pay any tax on its earnings. So you'll see if you look on our website for the same investment option, the pension fund is earning 0.5% to 1% more in terms of returns.
Absolutely. Thank you, Paul. So when we talk about making contributions and tax effectiveness, certainly one of the best ways to build your superannuation account balance is by making pre-tax contributions. So making salary sacrifice contributions. And as you can see there, on the table, most people, I guess, are in the $41,000 to $120,000 income bracket. So your marginal tax rate is 32.5%. So when you direct some of that money to your superannuation account as a contribution, you already have an instant tax savings because that money is only taxed, as Paul mentioned, at 15%. And that's taking absolutely no risk. So an instant tax savings, then your money is in your superannuation account and compounding year on year. And you can see as your income increases, so does your marginal tax rate. So hence that tax savings increases as well. But if you're earning below $18,000 a year, well, salary sacrificing may not be the best thing for you, and maybe you should be making after-tax contributions, and we'll talk about those in a little while. Now, Paul, could you actually take us through this example of someone making salary sacrifice contributions, please?
Yeah, sure. So as we said, super is tax effective because the fund doesn't pay any tax on its investment gains. But then, as we've said, you can also save tax when you make contributions. So if you're earning over 45,000, everything you earn over 45,000 is taxed at 30-odd%. Sorry, 35-odd%. But if you put it in as salary sacrifice or as concessional contributions, you only pay 15%. So here's an illustration here. Somebody who earns 100,000 a year decides to salary sacrifice 5% of their pay. So their taxable income reduces and they have a tax saving of $66 per fortnight, which is $1,716 a year, or $17,000 if they keep it over 10 years. One thing we do need to remember is that that's the saving in income tax. They will pay the contributions tax, which on this example runs out to about $28. But they've still got an overall saving of $38, which is the 20% that we were talking about.
Yes, certainly very effective, Paul. Okay, so we spoke about salary sacrifice contributions. Now your 10% superannuation guarantee contributions, any additional employer contributions you may receive, and any personal deductible contributions are all called concessional contributions, and they are treated the same way. They're all taxed at that 15% tax on entry to the superannuation fund. Now, there is a yearly limit on how much you can actually contribute each financial year concessionally, and that's called a cap. And this year, from the 1st of July 2021, that cap is $27,500. Now, Paul, I know we were chatting about the carry forward rule the other day, and you mentioned that you have many of our members, they actually aren't taking advantage of this rule. Can you explain that rule to us, please?
Yes, this is becoming more and more important and helpful for people because as of the financial year 2018-19, which is now about 3 financial years ago, any of that cap, which was 25,000, is now 27,500 that you didn't use, carries forward and is available to you for the next 5 years. So it's not a use it or lose it anymore. Yeah. Now this is becoming quite a helpful issue for a lot of our members, because those who've been on, say, earning 100,000 a year and haven't been making any contributions of their own, probably their employer put in around 10, just for a round number. That means there's now 3 years in which they've had 15,000 spare. So those people now have 45,000 that they available for them to contribute from the carry forward, plus this year's 27,500. So that's, for most people, bearing in mind they need to live off something, that's almost limitless ability to make concessional contributions and save tax.
Yeah, absolutely. Thank you, Paul. So I mentioned before after-tax contributions. Now these are also called non-concessional contributions. And as you can see there, they have a totally different limit, a lot higher. And the reason is, look, we spoke about share portfolios before, and also investment properties. And sometimes people are actually trying to sell those assets and get that money into the superannuation environment. So currently, if you're under the age of 67, that limit is $110,000 per annum. And you could potentially bring forward another 2 years worth of contributions and contribute $330,000 in 1 financial year. But then you cannot make any more contributions for the next 2 financial years. But if you're between the ages of 67 and 74, the limit is the same. It's $110,000, but you just don't have that opportunity of that bring forward rule. But you do need to meet the work test. And the work test isn't too onerous. It's only working 40 hours in a 30 concessional day period in that financial year. But if you're over the age of 75, you can no longer make those contributions.
One thing to add there, though, is before people think about those non-concessional contributions, just check, maybe get some advice about what you got with carryover and have you made use of everything that you can get a tax saving on. Because with the concessional contributions, the tax saving contributions don't just have to be made through salary sacrifice. You can do lump sums. So if you are selling the share portfolio, or you've sold the investment property, or you've got an inheritance, first thing to check is, can I, before I put a big lump sum in as non-concessional, check, oh, I wonder if there's an opportunity to save some tax with this as well.
Absolutely. And I think the government is also looking at that work test for those between 67 and 74 and potentially removing that from the 1st of July next year. So that's a watch and see. Yeah. Okay, now, Paul, you mentioned this earlier with your principal place of residency or your own home. Can you explain particularly the downsizer provision available to people?
Yeah, so the downsizer now allows you to, if you sell your primary residence, it allows you to put some of that into your superannuation. Now, at the moment, it's you have to be over 65, but as of next July, it's going to come down to 60. But if you meet the age requirement and you've held your property, or one of you, if you're a couple, have held your property for 10 years, then you can each put, as long as you're both met the age requirement, you can both put up to 300,000 into each of your supers. That is not subject to any of the contribution limits we've just talked about, or it hasn't, and it doesn't have any age limit on it either. So it doesn't. You can do this at almost any time. The other thing which is interesting about this is there's no specification that says that the house you buy after selling actually has to cost less. So there are strategies. They're a little bit out there, but there are strategies where you could have somebody with a large amount of cash they want to get into super. So they sell their home and move and put the cash into super and potentially could buy something bigger.
Absolutely, yes. You don't have to downsize to use.
No, you don't. It doesn't actually have to be smaller. Yeah. You just have to have sold. You can only do it once. That's one of the limits on that.
Yeah. And I know it can certainly be, there's quite a few, I guess, rules that you need to meet. So it is important to get some advice if you are considering doing that, and there's time limits involved as well. Yeah. Yes.
But it does allow you to, as I say, it's a bit like with any property, it's not liquid, but that is a nice way now for people to be able to make some of their assets a bit more liquid and have them then invested more diversely. Because when people invest outside super, you can invest across a whole range of investments. Most people tend to keep it in the bank in cash.
That's right. And how does the spouse contributions work?
So this allows us a spouse to make a contribution to their other spouse's account, and if their spouse is not a high earner, then the contributing spouse gets up to 18% tax offset for up to a maximum of on $3,000. So basically, it's not the tax max. You get a tax offset of up to $540 by doing that.
Yeah.
Nice little. It's one of those everything helps contributions.
Yeah, absolutely, Paul.
And the other thing people do is look at consolidating their super as well. You can, particularly if you have a lot of very small accounts around the place, they can get eaten away. There aren't a lot of fixed charges on the accounts these days, but one of the things that eats super is insurance. And every fund has to offer insurance to its members by law, and that if you can have multiple insurances, they can eat away at the accounts, and some of them won't even be any use. Because particularly with income protection, you'll only get paid at one time by one policy. So that's another way of it's a way of consolidating, but it's also a way of protecting your super and making sure it doesn't get eaten away.
Yes, and I think the best place to actually find some of your, if you have lost your superannuation, or you're not sure how many funds you have consolidated, but if you go to MyGov and you have linked the ATO, so the tax office, to it, you can then, there's a superannuation section there, and you should be able to see all your superannuation funds. And if you want to consolidate those, you can actually do so without any paperwork by ticking the boxes. But certainly, as Paul mentioned, you do need to consider any insurance cover you may have before you go through that process. Very important.
Yes, those we have access to that same tool through people's online accounts if they want to do it. And if you're struggling with making that work, our call center also has access to exactly the same tool. So we can certainly help you with that if you want to do it.
Yep, excellent. Okay, now that we have covered how you can contribute to your super, we would like to now explain how to access your superannuation. I get asked this question a lot from our members. Essentially, the answer is, well, when you reach your preservation age, and certainly, first of all, within the 58 to 59 bracket, and you retire, so, or you start a transition to retirement pension. So if you're, and it's all based on your date of birth. So if your date of birth is between the 1st of July 1962 and 30 June 1963, your preservation age is age 58. And if you're born between the 1st of July 1963 and the 30th of June 1964, your preservation age is age 59. And if you're born from the 1st of July 1964 onwards, your preservation age is age 60. So in that bracket of 60 to 64, you need to cease an employment arrangement. So that's called a condition of release to access your superannuation. So you could potentially, if you're working at one diocese and you move to another one, that's ceasing that employment arrangement. And sometimes if you are working at the same diocese, you're working full time and you think down the track, you might want to work casually. You do need to make sure that you have a break in that employment to be able to access that superannuation. So you can't just be on their books. That actually won't satisfy the rule. But once you reach age 65 and over, it's all very, very flexible and you can access your superannuation whether you're working or not. So you'll have a lot of options available to you then. And certainly when you do access your superannuation, you have the option of getting a lump sum or commencing an income stream. And Paul will also provide you with details of how allocated pension works. Yeah. Thank you, Paul.
So yes, so you can access either through, as Rita says, either through an income stream or a lump sum. For most people in retirement, they would move to an income stream. So they open what's known as a pension account. They can put some or all of what's in their super or accumulation account into that account. And then that account can then pay them a regular income. So that's one of the main differences between a superannuation and a pension account. Superannuation accounts, you can take money out, but it has to be through lump sums. The pension the reason why a lot of people like it is because it just substitutes for their pay packet, give you a fortnightly payment. And the other benefits of the pension account, as we said before, is the pension account makes a bit more money because it doesn't pay tax on its investment gains. The slight fly in the ointment is that there is a minimum amount you have to take out of that pension each fortnight. If you're under 65, it's 4%. And if you're between 65 and 75, it's 5%. and so on. It gets more as you get older. At the moment, all these sums have been halved because the government has allowed people to take a bit less out if they think their portfolio has been hit because of COVID.
Yeah, absolutely. And you certainly can have access to lump sums as well when you have that pension running. So I know a lot of people get confused and think that they can also contribute to their allocated pension, but all your money has to go into your accumulation account, so your superannuation account. You cannot actually contribute to a pension account.
Yes, so that's why we said some or all. So it depends on people's circumstances. They may be still working. They may have a bit of money they want to put into their super. They may find that the minimum's a bit much and they don't need it, so they want to put that back into the super. And also insurance. There could easily be, there's often still insurance on some of the accounts as well. So that's always something we need to look at. We're doing advice is, how much do we need to put into the pension? How much should we keep in the super to make sure we maintain things like the contributions, the insurance, that sort of thing.
So forth, yes. Now, we have two different types of allocated pension products. Paul, can you explain Retire Choice first, please?
Yeah, so Retire Choice, as it says, as it implies, it's a pension account. It gives you a complete choice over what you can invest in. So it has all the same investments available to you that we have in our superannuation product. The only one it doesn't have is the lifetime one, because that's designed for people's investment mix changing as they get older and closer to retirement. But otherwise, it's got all the other diversified options. Shares are diverse, so it's got shares and it's got property and bonds, the more sector specific ones, and then it's got all the diversified funds, the growth, the capital, conservative balance, the capital stable, and so on. So exactly the same set of options and exactly the same fees as well as the superannuation account. And that allows you to have whatever investment mix suits your risk profile. Do you still want to go for a lot of growth? You could have shares and growth, or are you a bit more conservative? Do you want, a conservative fund, or do you like a bit more property in your portfolio? So that allows you a complete choice. It's got our full suite of investment options. You've got a complete choice of what you invest in.
And then, of course, we have our Retire Smart product as well, Paul.
Yes, so it's, maybe flip on to the next slide because it's got a picture that describes it better. It's what's known as this is known as a bucket strategy. They're quite popular. So what it does is it keeps part of your money in cash, usually about 2 years worth of your expected payments. And that's there to make absolutely sure that those payments can be made. And then the other part of the investment's in a fairly high growth investment, and the cash is constantly topped up with whatever dividends or cash distributions come from the growth fund, and it's also topped up with capital gains, but only in the years when the growth fund has met a certain threshold of growth. So the idea is to basically be tapping on the growth when it's doing really well, but tapping less on the growth and taking a bit more from the cash when it's not doing so well.
Excellent. Thanks, Paul. So now that Paul has explained the mechanics of the allocated pension, I guess the next question or questions you may have is, do I have enough to retire? And when can I retire? So, Paul, I guess this is really what you do.
Yes, absolutely. These are the core questions that people come and ask us. I want to retire. Okay, so the three main questions: when do you want to retire? How much do you want to live on? And how long do you want your money to last? And also, there's various things we can look at to say, what if we get hit by COVID? Are there things we can do to protect my portfolio? But that's the bread and butter of what we do in advice. And this slide here is just illustrating. Here's a couple of clients, Mr. Gary and Mrs. Mary. What do they want to do? Well, they want to retire at 65. They have 300,000 each in super. They own their home. They want 63,000 of income, and they're not aggressive investors. They're looking for a rate of return of about 5%. That's what we call a moderate sort of investor. And we're going to factor 2.5% inflation into their projections as well. So the core thing we would do for that sort of couple is do one projection like this to say, are your assets going to meet your needs? And if we look at this graph here, it shows here are the assets here. That's their super. They haven't got a lot else. They're spending it over the years, and actually they're not going to run out till their age 93. So that's one chart we would typically see from advice. Another would be this one, which would show their income, but also importantly the sources of the income. And there's a couple of points to make here. One is that that Centrelink is kicking in for this couple, not too far off. As we said, you can get a full pension with assets of around about 400,000 as a couple. If you're a homeowner, it's 487. But you don't get no pension at all until you've got about 800,000 in assets. So this couple with their 600,000, we're finding that Centrelink's kicking in fairly soon, almost as soon as they reach Centrelink age. So that makes a big difference to how long their money lasts, because first sight, you'd say, okay, this couple has $600,000. They want 63,000 a year. It's only going to last about 10 years. But with Centrelink, and also don't forget we've got investment earnings on their fund coming in, you'll see that this money has now lasted for, what have we got here, 30 odd years.
Yeah.
So it all has to be factored into, all these things have to be factored into the picture to see if our clients are actually going to meet their goals and have that comfortable retirement that they want.
Excellent, Paul. Thank you. So now we will move on to talk about Centrelink in more detail and the government age pension. So Paul, could you explain the age pension eligibility criteria?
Certainly can. So there's two eligibility, well, there's a number of criteria. You have to have met a certain age for if you're born after 1st of January 1957, that's going to be 67. And that's becoming increasingly common for most people I see. If you were born before that, then you're eligible a bit earlier. You have to be Australian resident, and there are income and assets. The pension is means tested. Sorry, so that depending on the amount of income or assets that you have, you'll get more or less. Those are the ages at which you're eligible. So as I said, if you're born after January 1957, it's going to be 67, and then 1st of July to 31st December 56, it's 66.5, and then for some people it's 60 if they're born 1954, 1st of January 54 to 30th of June 55. So it does vary a little bit.
Yes. Yeah. And for most of us, I guess, yeah, really is age 67, isn't it?
Pretty much, yes. So that's an important thing. If people are, a lot of people talk to me now, it's going to be 67. If you want to retire at 60, that means you've got quite a long time in which you're going to have to fund your needs and your retirement without the age pension.
Yeah, so hence it's important to note there the difference between the two. Sometimes people get confused as well. So you can access your superannuation, like we mentioned before, certainly from age 60, but then you would need to actually, like Paul mentioned, fund your retirement until you may also be eligible for the age pension at 67. So there is two tests, Paul. So first of all, we have the asset test to determine eligibility for the age pension.
Yes, Rita, and this actually is it's the one that hits most people first. You're paid age pension based on the lesser amount worked out through either the assets or the income test. For most people, it's the assets test that hits them first. As I said, for a home earning couple, it varies depending on whether you're single or a couple, and whether you're a homeowner or a non-homeowner. So you're allowed more assets if you're a non-homeowner. Assumption being you're paying rent. We see a lot of singles, but we see a lot of couples as well. So if you're a homeowner, you'll get the full age pension at with assets of about just over $400,000. And the important thing here is that it's not an all or nothing. So the pension, depending on what your assets are, it reduces, it shades down. That's that blue area in the middle. It actually, based on the assets test, your overall pension reduces by $3 per fortnight per thousand over the minimum. But the upshot of all of that is that you won't cease to be eligible for any age pension until you've got about 800,000 to 880,000 in assets between you. That's if you're homeowners. Now, what that means is that the age pension, that's why I said the age pension will come into the picture for most of the clients that we see, because as you get into, even if you start off with a lot of super, if you've retired before age pension age, you'll use some of that. You'll use some of that going forward. Eventually, some point for most people, if once they get into their late 60s or 70s or whatever, the age pension is going to come into the picture.
Absolutely. And then, of course, we have the income test, Paul. Yeah,
the income test. So you're allowed a certain amount. Again, it's different for couples and singles. It's not differentiated between homeowners and non-homeowners. But you're allowed a certain amount of income and still get a full age pension. That's $316 between you for a couple. And you can, again, the same rule of shading. The pension reduces by 50 cents each, 50 cents between you per fortnight for every dollar you earn per fortnight above that. But it doesn't completely shade out until you've got 82,800 of income between you. That income there includes what's called deeming. Centrelink assess a calculated level of income on your assets, as well as any other actual income that you may have. The other point to note, which I mentioned at the beginning, was you are allowed, there is a thing called a work bonus. So you're allowed to do a certain amount of actual paid work, up to $300 per fortnight each, and that doesn't count towards that income test.
Yeah, thank you. And I guess here are the actual rates of pension, Paul?
Yeah, so 24,700 if you're single, 37,341 if you're a couple, and if you're a couple and you're living apart due to ill health, one's in a rest home or whatever, then you get the singles rate each.
And then there's, of course, the Commonwealth Health Card as well that you may be eligible for.
Yes, now Commonwealth Seniors Health Card is quite a useful thing to apply for. If it doesn't have an assets test, it's solely income. And that income is actually for a couple 89,200 and something a year, so it's a bit more than the income test for the age pension. That's quite a lot of income unless you're actually working. If you need a lot of assets to get that just as deemed income. Because deemed income is mostly deemed at 2.25%. So even if you're not eligible for the age pension, fair chance you might be eligible for the Commonwealth Seniors Card. The key benefit is it means you have a maximum to pay on prescriptions of $6.60 per prescription, and a maximum per annum of $316.80 on prescriptions, after which they then free. So 48 prescriptions a year at $660, and then everything after that is no charge. Now that's been estimated to be worth for an average person, whatever one of those is, about 1,500, 2,000 a year.
Yeah, certainly substantial savings there. And then, of course, there's other benefits you may qualify for, I guess, or receive.
Yeah, they vary by state. You can look on the website, see what's available from your state, but there are discounted public transport costs available, or lower rates on your utilities and bills that might be eligible.
Yeah. Okay, so as you can appreciate, there are a lot of complex rules and regulations to consider, and they are all intertwined. Paul, can you explain how you have assisted your clients?
Yeah, so the core things we're looking at are the two bullet points in the middle there. So, what are the client's goals? When do they want to retire? How much do they want to retire on? And will their money last? And if it won't, well, what's the next fallback position? So that's the core question that most people want. It's the bread and butter of the advice. But at the same time, we're looking for other things which we can help with. So I think of this as the jam on top, and other things we can assist with. So can you save money in your retirement? Well, for example, have you made use of all your tax saving contributions? Are there some more that we could use now? Can we get you a bit more out of Centrelink? This comes in if there is a significant difference in the age of two members of a couple. If one is quite a bit younger, one of the rules for Centrelink is that superannuation assets don't count to the assets test. So there are ways in which we can move assets from the older of the two to the younger of the two. And that can add, again, quite a bit of value in terms of saving, increasing Centrelink. Estate planning. The money that people have put into super through their superannuation guarantee contributions is called taxable, and your dependents or your beneficiaries, if they're adult children, could pay tax on that. There are ways to take money out of super, recontribute it, that can save them that tax. And the other thing, again, another thing we look at is non-super investments. People, maybe older clients who can't meet these work tests, can't put enough into super, come into money, an inheritance or whatever. And one of the things we'd also do is look at how to invest that. We don't want it sitting in the bank, or we might want some of it but for the long-term investment, we're looking for better returns, and there's plenty of platforms outside of super where we can invest in just as diversified funds as we invest in super.
Yeah.
So all sorts of extra things we can do around basically the bread and butter, which is, how's my retirement going to look?
Yeah, absolutely. So it's not just about retirement planning, but also, as Paul explained, other areas as well, and certainly available to non-members, not just our members. So yeah, certainly a worthwhile process to go through. And Paul,
it's probably a good point to emphasize is that yes, often there's not one, it's only one member of a couple that's a member of the fund. It doesn't happen very often, but theoretically we can advise if neither are members of the fund. There's no reason we shouldn't. We don't have any obligations to recommend our fund if it doesn't meet our members' needs.
And could you explain a little bit about the cost of our comprehensive financial planning services, Paul?
Yeah, so if you haven't seen an advisor before, you'll get an additional meeting, which is at no charge. And then if the planner thinks that they can help you with advice, they'll quote you for a fee at the end of the meeting. Now, realistically, that fee will be somewhere around between $1,500 and $2,500. It will vary a lot depending on how much work there is to do. But two important things to know about our fees. One is we have strict rules that say we cannot advise members or take fees off them if we can't demonstrate that we're adding value. And the second is we only take fees off members when we're doing work for them. So there's no annual percentage added to your account and taken off it. You pay fees when you come and see us and when we do work for you.
Absolutely. So the benefits actually do take two different forms. Obviously, the tangibles are the strategies and the dollars, and the intangible benefits, I guess, would be the peace of mind, control and confidence that you gain. And also, I guess some of the members that I've spoken to also have relief. Some members don't realise that they could actually retire, and after seeing a planner, they go, oh, I can actually retire. I didn't think I could. So yeah, there's a lot of benefits there.
I've had I've had a couple of clients. One lady who was in her 70s, and she literally said it once I'd finished presenting the advice. She said, "Do you mean I don't have to work anymore?" I said, "No, you're fine."
Yeah, absolutely. All right, so Paul has explained our comprehensive financial planning services, but we also have our general advice and over the phone or limited advice services as well, Paul, don't we?
Yes, so general advice doesn't necessarily have to come from an advisor. That's just information that is relevant to you and that you might want to consider. But it always comes with a warning. You need to check it applies to your personal circumstances before you act on it. So it's just information. It's not telling you should do one thing or another. We do have a limited or over the phone advice services. Now that is, it's at no charge. It's available to our members only, and it can offer you advice on 3 topics. So that is your actual investment within the fund, how your money's split up between the different assets. We can advise on contributions to the fund. So, should you be doing salary sacrifice, pre-tax, post-tax, how much, what's the impact on your take-home pay? We can do a little projection based on the limited advice of what your super might look like based on putting more in. And the other topic then is your insurance within the fund. Everybody in the fund has a basic level of insurance, but that's what it is. It's a default level that we give to everybody. It may or may not suit your needs. So that's another thing. And we can advise on each of those 3 specific topics at no cost.
Absolutely. And if you are interested in receiving any of the advice, we do have a link in our chat facility at the moment that you can actually put your hand up for receiving that advice, and we'll organise that appointment for you. Okay, so other webinars to look out for. The next one is next Monday on the 9th of August, and that will be our quarterly investment webinar. That is presented by Michael Block, our Chief Investment Officer. I would encourage you to register for that webinar. Michael is very good at explaining some of those very complex investment terminology and so forth in a very easy to understand fashion. And you will also have the opportunity to actually ask him questions. And we certainly do have further retirement planning webinars available on our website as well. So in case you would like a refresher of the information that we've provided you today. So please have a look at that on our website and register. The other thing I wanted to point out to our members is that if you haven't registered for the member portal to access your superannuation, please do so. We just need to have a valid email address and also your phone number or your mobile number to be registered for our member portal. You can do a lot of things on that portal there. You can change investment options. You can look at your insurance cover. You can look at the returns. Also, if you have a pension account, you can see the details there as well. You can nominate a nominated beneficiary, not a binding one. So there's a lot of information and that you can have a look at there. So certainly our contact numbers, our call centre, our 1300 number is open. Our call centre is open on a Saturday, I think from 8 till 5, I believe. And also our website I mentioned before at catholicsuper.com.au has a lot of information there. So I would now like to also introduce Justin Colling, who I mentioned before. Welcome, Justin. He may actually have some questions for us. So thank you, Justin.
Thanks, Rita. So thank you for the webinar so far, Rita and Paul. Been very informative. We have a couple of questions that have come through so far, but just a reminder, if anybody has any questions, please put them in the chat box or the Q&A section on this webinar, and we'll get to them shortly. But Paul, the first question will be for you. What are considered assets? The home, anything else?
Oh yes, so for the super, you're talking about we're talking for the Centrelink assets test.
That's right. The question came in during when you were talking about the
most the key things that are not counted for the assets test for Centrelink are your primary residence and any money in a superannuation account where the member is under pension age. Those are the two that will be most relevant for most people. There are other things. If you want a complete list, you can have a look on the ATO. Things like war medals and so on don't count for the assets test either, but they're not. And there are things like funeral bonds and money put aside for funerals and that sort of thing that don't count for the assets test. Sometimes people use those to increase their super. So we will look at all those things, but say the two primary things that matter to most people: primary residence and money in super under pension age.
Thanks, Paul. Rita, I'll ask you this one. What are the salary sacrifice limits?
20 in total. Your salary sacrifice also includes your 10% superannuation guarantee contributions. So the total limit for this financial year is 27,500.
But don't forget the carryover.
That's right.
Can be a lot of money.
Certainly can be, Paul. And Paul, the next question back to you is, do you pay for a review of a previously paid advice?
Yes, we do have a review fee. So your first appointment, if you've never seen an advisor before, is at no cost. But we do have a review fee if you come to see it. Even if you've had advice, there is a fee for then subsequently seeing the advisor of $380. That's just to cover the advisor's time. I need to, if I'm seeing somebody again after 2 or 3 years, I need to pull their file, look at what advice I took before, see what their balance is, generally prepare for the appointment, and we have a general discussion. And then if there's further advice to be done, which I think will add value again, there will be another fee.
Right, thanks, Paul. Rita, can I take a lump sum out of a transition to retirement allocated pension?
No.
No. Thank you.
Well, you can.
I'll put a caveat on that.
Yeah, yeah.
Not generally speaking, but you do have the opportunity of taking a yearly payment. Okay, so that in essence is really a lump sum. Okay, so but generally speaking, it's no, but yes, that option is available.
Thank you. And just a reminder to get those questions in. I've only got 2 more to ask you, so get those fingers typing if there's any more questions. Otherwise, we'll be finishing up shortly. So this question is if your spouse makes a contribution to your super account, is this amount separate from the 27,500 cap they're allowed to salary sacrifice?
I'll take that one. Well, in that sense, it is, because it's not a salary sacrifice contribution. It's a non-concessional contribution, and it counts towards the non-concessional contribution cap. So in your fund, if your spouse has put the money into your fund, it's a non-concessional contribution for you.
Great. The next question is an interesting one, or the last question I've got, unless one comes in, is can I retire, or can I officially retire to access my super, then rejoin the workforce?
Yes. It depends how old you are. If you are, you can do that if you're over 60. If you are, well, actually, you can do it. You can do it if you're under 60. The rules for retiring if you're under 60 is that you have to retire and not intend to work again more than 10 hours a week. So you really have to be retired. However, the rules do say you are allowed to change your mind. You're not allowed to do it too often. That's all. The tax authorities will get suspicious. But yes, there is a reasonable provision for retiring, but for whatever reason needing to go back to work. So you can under 60. Now, once you're over 60, the rule is simply that you have to have given up an arrangement of gainful employment. So if you leave one job and start another, you have complete access to all the super you have earned up to that point. And even if you have 2 jobs and you give up one of them, you have met the condition of release and you have access to your super. So basically the answer is yes.
Great. Well, no more questions have come in. So thank you, Paul and Rita. I'll hand back to Rita to wrap things up. Thank you.
Thank you very much, Justin. So thank you everyone for joining our webinar again. And Justin will also send you out a survey tonight for you to complete. So we do welcome your feedback. So please complete that feedback sheet for us. We'd be very grateful for that. And thank you once again. Thank you, Paul, very much for your insights and information tonight. And please, everybody, stay safe as well. So thank you.